This is MacroVoices with hedge fund manager Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Let's move on, Patrick, to this week's Postgame chart deck. Listeners, you'll find the download link in your Research Roundup email. It says Flirting with the 50-day moving averages. And on page 2, we have, you guessed it, a chart of the S&P 500 stock index futures. Patrick, what's going on here?
Well, I want to just stop and go back to the 50-day moving average in a bigger picture, which is it's the average price of 50 days. And so when a market trends, it breaks away from that 50-day moving average. And you can usually identify trends, really beautiful trends. Inevitably, the market always moves in ebb and flow. And every rally that occurs in a market mean reverts, and there's some sort of backfilling. And it is quite common for a very typical pause in the market or a correction to just mean revert back to its average price of the, let's say, last 50 days. And that's why a lot of technicians and trend followers tend to anchor on that 50, 100, and 200-day moving averages or 13-week moving average or whichever one that is to your fancy. And really what I wanted to identify when we're looking at these charts is that we had markets that were trending quite strongly over the last kind of 5-6 months. And almost all of these charts are showing that mean reversion, that correction, and they're all flirting with now having dropped to their 50-day moving averages. And this is such an interesting crossroad in the market, because if this was just the market pause and if it was just a little correction, then the question is this a buy on dip on all of these things? Or is there something more ominous afoot where these corrections can turn into something a little more bearish? And I just wanted to kind of go through these charts and see where we're at with all of these at these different points. And so the S&P 500 on page 2, we have flirted with that 50-day moving average both in January and March, earlier in March. And we're back there again. And each time that we've corrected down to this 50-day moving average, the market has more or less, the buy and dip traders came back each time. And we find ourselves now again testing this zone. It's going to be really interesting to see whether the bulls can hold the line here right around this 3850 level on the S&P.
Okay, so 3850, about where we are, just a little below where we are right now as we're recording on Thursday afternoon, is the number to watch on the S&P 500. Let's move on to the other indices. We've got the Russell on page 3. Looks like we're already below it. Is that significant?
Well, it's significant actually with the magnitude of selling in the last week. And what we've seen, and something we've talked about here on this show numerous times, was during the whole reflation trade and everything that was working, we had everything from the financials to cyclicals to value and small caps all doing incredibly well. And the Russell actually during the entire period since November has been leadership, and it's been outperforming. And what we witnessed happen in the last week on the Russell was a selling of such magnitude that it wiped out the entire March rally. While the S&P 500 is barely mean reverting that rise, the Russell has given it all back. And that immediately acts as a warning to me, because it's like, has something shifted in that let's say, a Russell over Nasdaq chart that we've shared in the past as well. Now, often when you see this type of selling, if we see a failed rally come on the other side of a bounce here, that may often indicate that the Russell is going to either underperform or even go through a deeper correction. And I think that we can't ignore what's happening in these small caps.
Nasdaq 100 futures is the next chart, and it too is already below the line, below the 50-day moving average. What do you make of that?
Well, it's not just that it's below its 50-day moving average, but unlike the S&P and the Russell that were in the month of March able to make higher highs The Nasdaq has not. In fact, the Nasdaq is barely beat a 50% retracement of the sell-off that started in February. And almost every attempt to rally has been met with selling. And it just feels very much like almost a gold chart, which is just rolling over. And this is going to be key because the Nasdaq has been the leadership higher. And if we see things like financials and small caps and all these other sectors that have been doing so well, if they begin correcting and something like the Nasdaq doesn't step up and take the baton to be some sort of leadership in this rotation, then you have to ask that question, what part of the market can be the leadership in order to drive another bull run? And the fact that we're seeing cracks in the armor for the Russell and the Nasdaq misbehaving, it really does ask that really important question, what is going to drive the next advance in the market if these supports do hold, right? With that said, Eric, I want to look on page 5 here on the chart of the financial ETF, the XLF. And what was really interesting is that the financials, whether you're talking regional banks, even global banks, all of them, the money center banks, they have truly been one of the hottest sectors throughout this last kind of 4, 5, 6 months. And they have been continuously advancing even when other parts of the market were correcting. And it's really interesting in the last week, we finally have seen that correction kick in on these financials. And the financials are slowly approaching that 50-day moving average, where back in January acted as a great buy on dip opportunity. And this is also, again, something that I'm watching, because if we see that the financials can turn around and be that leadership, well, that would be a bonus or a plus for the bulls. But as we approach here, whether or not the financials act as a buy on dip here, I think is one of the little puzzle pieces that is totally worth watching.
Patrick, as I look on to page 6, I'm having a hard time reconciling what this VIX chart is showing me with what you said earlier, because, boy, when you talk about the S&P flirting with its 50-day, the Russell's already below it. The Nasdaq, which led the way up, appears to be leading the way down. It's already ventured substantially below its 50-day, and it's now still below it, but trying to hug it a little bit more. Boy, it seems like things are heating up. Volatility's increasing. Situation's getting a little bit scarier here. But then I look at page 6, and it shows that we've just passed a new, looks like 1-year low in stock index volatility.
Yeah, this is actually one of the more interesting things I wanted to observe, right? So the 50-day moving average, I don't want to use it as a predictive power on as something like the VIX, which is far more range bound, but the moving average shows you just sort of what the average price has been. And what I find fascinating is the last 2 times we had little quick market corrections, the VIX went ripping higher up into the 30 plus 38 range. And here we haven't even seen the VIX react in any meaningful way off of the lows. In other words, like that fear premium that tends to be put into options for people that are hedging, doesn't seem that this time around we're getting that kind of blast higher. And I'm wondering whether that is something that's warning of too much complacency into this little correction, or whether there just is that much active vol selling that is allowing this to be suppressed. But watching whether the VIX starts to react on the upside here during this little pullback is 100% on the radar.
Let's move on to the dollar index, Patrick, because one of the things that a lot of people have said is that the biggest threat to the stock indices would be if a dollar rally started to go out of control, which some people have cited as a major risk factor. It hasn't gone out of control yet, but boy, this dollar rally is starting to look like it's got some legs to it.
Yeah, Eric, when we're looking at this dollar index, the interesting part to me is that because the U.S. dollar still is the world reserve currency, it tends to be still an anchor for the reflation trade. And really one of the things that we've been watching on the show for the last month is whether or not the dollar was going to put in a bottom. We were talking about it all the way through January and February. And really what we have seen for the first time in over 6-7 months, a sustained period from which the U.S. dollar dollar has been able to maintain above that 50-day moving average. I mean, during the entire US dollar bear market in traditional form, it stayed decisively below that 50-day moving average. And so there is a shift of trend. And what we have now is 3 consecutive days of attempting to break out above 92 and consolidating well above that 50-day. And so really it's starting to look like that dollar index may very well go here. And it will be interesting to see is that will that be enough to send the ripples through the intermarkets and cause other markets to start getting a little bit nervous. One way or another, there's definitely some sort of a shift happening there.
Patrick, let's move on to your Bitcoin chart. Now, I noticed finally, it seems like the news flow is starting to say, oh my gosh, there's a real serious risk of Bitcoin being outlawed by governments. Whoever could have seen that one coming? I don't know why that wasn't an obvious risk to everyone before, but it seems like it's suddenly on the radar. Is that what's driving the downside?
Well, I don't even know if I want to overread the downside just yet. What I find really interesting with that 50-day moving average there is that almost every advance Bitcoin has had, the buy on dip traders were very quick to buy this 50-day moving average. Every time we mean reverted and retraced some sort of an advance, this is the zones where the buy on dip traders came in. And it worked in January. It worked again in late February, early March. And here we are again in late March, and we are testing this 50-day moving average. And I think it would be a huge tell if the buy and dip traders didn't show up this time. And before I make a big predictive call on this, I think it's worth at this moment just observing over the next a week whether or not we see some sort of new accumulation come off of here. I think that it would be a blow to the Bitcoin bulls if we saw selling south of 50,000 and failed rallies on the other side. And that would really mean that some sort of a distributive cycle has potentially kicked in. It's premature to jump to that conclusion, but boy, are we at an interesting crossroad right now where typically we would have seen those buyers come back in.
Let's move on to my own favorite chart, crude oil, on page 9. Boy, we certainly see that 50-day moving average has, if nothing else, generated plenty of volatility in the chart here, hasn't it?
Exactly. And again, this is just the way that we describe the 50-day in the first place, which is that during bull trends, the price decisively moves away from that average price and goes in full trend higher, and then often mean reverts back there. And what's interesting here is that the 50-day moving average now is where the crude oil is toying with. There are some fib retracements that lie a little bit lower in the mid-50s that could also be where crude oil could correct into. But we have seen in the past the 50-day moving average at least offer a reaction. And so was yesterday's reaction all we're going to get, or is there still going to be a quick bounce here into the low 60s? It's going to be really interesting to see. But this really is very consistent with where we are on so many other commodities as well. Because like when we go to page 10 and look at the copper chart, similarly, copper had that huge run in February. And again, we're just mean reverting and correcting right to that 50-day. And in a commodity bull market, these types of corrections happen, and these are the levels that typically would be bought on dip. And this is why Flirting with the 50-day is the title of this whole presentation, is because we're literally there at so many of these markets. And it's going to be revealed to us over the next few weeks as to whether this was just a great buy on dip opportunity in these markets, or whether these corrections are going to be much deeper, more prolonged, because typically if the 50-day doesn't hold, then one of those kind of multi-month, much deeper corrections ensues. I think it's premature to conclude a bear market or something more ominous like that. But for many of these markets, this is a moment where we're going to find out whether the trend that's been established for the last 6 months has or is going to be interrupted.
Before we close, let's go back to page 9 and look at crude oil again. I'd like to talk a little bit more, since you're the technician in the house, about levels that are possible. Let's assume, for sake of argument, that we do get a breakdown below this 50-day moving average. Okay. We had one of those back in October, and it actually set the stage for just an epic rally. So, maybe that's not a bad thing in terms of, shaking the weak hands out of the system and preparing the market to maybe stage another big move higher. Let's talk about where the downside targets would be if we do see sustained closes below the 50-day. Where do you think the next levels are? What should we be paying attention to?
So, Eric, if the 50-day moving average doesn't hold, then looking for a 50% retracement of the entire oil rally off of that $36 low that subsequently rose up to that $67 high, a 50% retracement would be roughly around $52, where that January consolidation occurred. And so I think that would be a very realistic first target for a quick correction down, where one would be able to potentially look for the next buy on dip opportunity. But first, I think before already assuming that that's a given, I want to see whether this 50-day holds here. But if it doesn't, then that would be definitely where I would be looking for the next little correction to go.
Well, I think we're in strong agreement then, because what I'm looking for here is almost the same number you are, Patrick. You've got the 50-day at 58.24, and that's one number. I think another interesting number is the 13-week moving average, because that would be the signal, if we close below it on a weekly basis, that tells you not only the daily trend has changed, but also the weekly trend has changed. So if we see a close below 57.41, the 13-week moving average, and by that I mean a weekly close, not just a daily close, that says to me probably we're headed, I think, to exactly where you said, somewhere around that January, the top of the January consolidation range, around $52, $53. If there was some particularly bearish news, I could see maybe a very brief test of 50 or just below 50, but I don't think we're going to spend much time below 52 or 53, and I think 53 is probably about where the buying zone starts if this level doesn't hold.
Yeah, and well, the really interesting part about this moment as well is that no matter where it goes, whether it stops here or whether it goes down toward that $52 range, I do believe that these are going to be great buying opportunities, and that's one of the things that we're looking at doing with, we locked in the advance in a lot of the energy stocks and other things, big picture trading with collars, and so we have a lot of our profits already locked in, and so really the question is, when is the next great buy on dip opportunity for us to be able to reposition for another leg higher? And so it's certainly something on my mind.
And needless to say, the best way for our listeners to tune in to what's on your mind, not just every week on Thursday, but every single day, is by signing up for a free 14-day trial of Big Picture Trading. Information is on page 11.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week, free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.